Rightio, we're back. Episode 2 of our Nameless podcast. Welcome back, Paul. Thanks for coming on again.
Me again.
That's it.
Must have done a reasonable job the last time. You invited me back.
Something like that. I did a lot of agreeing in the last one. So, all right. So this one we're going to talk about self-employed and what it's like for self-employed people to get into the property market. So I'm going to ask you a few questions around that.
My favourite subject.
That's awesome. Okay, so what we're going to talk about is how it works, the misconceptions, and the way to do it right. So the first question is, why do so many self-employed people think that they're never going to get approved for a home loan?
Yeah, I mean, I guess it is a bit of a misconception out there. I think a lot of self-employed people don't understand, what the requirements are. So, and I guess if they go to a bank won't tell them what the requirements are. They'll just say yes or no. And so therefore, I think there's a lot of customers get into that trap of not knowing, well, what do I need to do? What paperwork, how long do I need to be self-employed before I can get a loan? And there are so many variables with self-employed lending that, there isn't one kind of hard and fast rule, but we kind of simplify it a bit too.
Yeah, absolutely. Do you think it is harder to get into a home loan being self-employed rather than being, the standard PAYG employee?
Absolutely not. No.
Yeah, and that is a huge
They're just different variables.
Exactly.
I guess as a PAYG employee, again, all banks have got their rules around, how long you have to be employed before they'll give you a loan, whether that be, some banks have got a one-day policy. If you're PAYG full-time and or permanent part-time, you can get a loan from day one.
Yep.
Other banks want you to be on probation. If you're on probation for 3 months or 6 months, you have to, see out that probation before they'll lend you money.
Of course, yeah.
To make sure that I guess it's all about where this kind of misconception comes from, or we talk about, well, is it easier or is it harder? It's all about the bank understanding if that source of money is going to continue and at what levels.
Absolutely.
So as a PAYG employee, you get X amount of dollars for working a 38-hour week, whether it be paid fortnightly or monthly or weekly, you get paid X amount of dollars. Why they want to see that you're outside probation is to make sure that is going to continue, that you're right for that job and the bosses think you're right for that job. With self-employed, it's a little bit different because you are the boss, right? So when we put our figures together and why we generally need 2 years financials, just to show that business has got a consistent turnover. And they want to see that business is actually growing rather than decreasing. If you have one good year and then the next year is not as good, is that a trend that's going to continue, or is it a trend that, is going to turn around? So it is a bit more difficult in terms of getting a home loan as self-employed, but not necessarily.
But it's not harder, yeah.
Not harder.
So what documents, coming off from that, what documents would a self-employed person need to apply for that home loan?
Yeah, look, with self-employed, there are probably a lot more opportunities or a lot more different types of lending available to them as opposed to someone that's PAYG. Because we've got what we call, we've got full doc loans where we're providing all the financials, and then we've got alt doc loans where we don't necessarily have to provide, or we use alternate documentation to verify the income. So if we will look at, and we'll break it down into the two types, right? So if we look at a full doc loan, again, it comes down to the different types of structures for a self-employed person. So when we talk self-employed, that covers sole trader, partnership, trust, and companies.
Yep.
They're the 4 different types of structures in self-employed. So as a sole trader, you'll need your 2 most recent tax returns,
yep,
along with tax assessment notices. If you're a partnership is essentially 2 sole traders operating together under a partnership, right? So they'll have partnership returns plus their individual returns and associated notices.
And I think a lot of people do think that is, in a sense, a company.
It's not.
But it's not,
No.
They're 2 individuals that are working together in partnership.
And again, it comes back to what documentation that we get. So as a partnership, you'll have a partnership return and then you'll have individual returns, and that's it. You won't have financials like you will have in a trust and a company. We normally get, not only do we get the trust returns, but we'll also get financials. Now, financials are basically done up by the accountant, and that is your profit and loss and balance sheet and notes to the effect. And that basically tells the story of the loan, right? It'll tell you, what your income is. And typically the way that we work out income for self-employed is we've got our total sales. We've got less what we call cost of goods sold.
Yep.
So what does it cost us to make a sale?
Yep.
We take that away, and that gives us our gross profit. We take our gross profit less all of our expenses, gives us our net profit, which we can use, plus add backs. Now, the things we can add back in out of our expenses are things like wages to associated persons, depreciation, and interest on any loans that are associated with the business. We can add those amounts back in.
Yeah, definitely.
So that's where the financials come into. And balance sheet, why we need that also tells a different story. That'll tell us what our current liability, current assets, non-current assets, current liabilities, non-current liabilities. So that's basically the health of the business, how much equity we've got in it. In other words, how much do we owe compared to how much we own?
Yeah, exactly.
Right? Same as a net asset position for a PRYG person. That's how we look at, it has that business going backwards or is it going forwards?
Exactly.
Yeah.
And with that as well, a lot of business owners do try to do their absolute best to minimize tax. Do you think that affects the loan process and their borrowing capacity and things like that? Obviously, it's
to a
common.
degree, yes.
Yep.
But no. I mean, I guess, in some ways, the accountant's job is to try and minimise a self-employed person's tax. So they're always going to include more expenses to minimise that tax amount, right? From as a mortgage broker point of view, we want them to earn as much money.
The absolute opposite.
Exactly opposite, yes. Because, obviously the more money we've got to play with, the more.
Yeah.
But the simple rules still apply, and ultimately there are things that an accountant can do in terms of directors' loans and things like that are really just paper-based loans. It helps them for their tax from the ATO perspective. Doesn't really affect us whatsoever. There's still only X amount of sales, less your expenses equals our profit that we can use, plus whatever add-backs. And there are certain things that we can do as well, like if there are one-off purchases, like if things like instant asset write-off. We can, you get all the depreciation from that. We can, include that straight away as well.
Yeah.
But again, it comes back to the bank. So not all banks, every bank has slightly different rules on what they'll allow and what they won't allow in terms of depreciation, net profit and expenses and all that.
And that comes back to every bank's different. And going into your majors might not be the best or the only opportunity you have, because
definitely not.
People look into their local branch and think that's the only and the best deal, because why would they give us a deal that's not
we've come back
perfectly suited
to,
for me?
talking about documentation. That's the documentation we typically need for a full doc loan, and then we've got alt doc loans. So an alt doc loan is essentially alternate documentation, and this is where our non-bank lenders can do loans for self-employed, typically up to a maximum of 85% LVR, so we can't go quite as high as what a full doc loan can go. But if we've got a bit of equity there, we can do loans from, you may have only had an ABM for 6 months, and we can get you a loan. So you don't have to have that 2 years like you would traditionally in a full doc loan.
Exactly.
And we use things like business bank statements to verify income. We use BAS statements to annualise those out to verify income. We use an accountant's letter. So if an accountant says, yes, it's affordable based on the information.
Yeah, and we do look at the business income as your own as well as a self-employed. It's not just it's not just a fine line. You may own the business and pay yourself a small amount, but we also take into consideration how much that business is making. So,
and again, where the complexities lie is if you've got, if you're in a company and you're one director, there might be 3 other directors. Then, when we're looking at the total income and so, we're then only taking a third of that
Exactly.
that income, as well as only using a third of depreciation, interest, and all those sort of things, and a third of the debts as well.
Exactly. So what do you think the absolute minimum is deposit-wise to get into the property market nowadays?
I mean, it really varies.
Yep.
I don't think there is a specific minimum because, we've got lenders now that, we'll take we got lenders. We're about to get a lender on the panel at the moment that has 98% loan, including LMI. So,
crazy. 2% deposit.
it comes down to what. It's not about rate as well or minimum deposits. It really comes down to what's best for the customer based on their own personal circumstances. Everyone's totally different. So if someone's got more equity, then we can generally help them with more options. If they've got limited equity, then we're limited in what options.
Exactly. So the lowest rate isn't always the most important thing?
No, definitely not. Because, you can, and I speak to our brokers a lot around, a lot of brokers sell on rate and rate alone. Because when we speak to a customer, the first thing they say is, well, what's your best rate?
Yeah, 100%.
Now, if I sat you down, Rolly, and I put a bit of paper in front of you and I said, right, now I want you to write down your financial goals on that bit of paper. Where do you think rate would be in that bit of paper? Would it be on there?
Yeah, probably not. Down the bottom.
Because it's not actually a financial goal to get a cheaper rate, right?
Yeah.
Your rate is a means to an end, right? Yep. So as a mortgage broker, I don't think we need to be focused on rate. What we need to be focused on is what are the goals of the customer and how do I help achieve that? And so the cheapest rate may not necessarily be the best product for
100%.
that customer because it may not, your cheap rate might be a basic loan that has no bells and whistles and doesn't have any features that will help them pay off the loan.
Exactly right.
Like offset accounts or package loans or whatever.
Exactly.
There are certainly better loans out there that might be slightly more expensive, but will make your money work harder for you and you'll get more return on your investment than a basic loan.
Exactly. So. And while talking about offsets and redraws, do you want to shed some light on the difference between the two and what they're actually used for?
Yeah, so they're very similar in a lot of ways and we use them for different purposes as well. But a redraw essentially is where we're putting any extra funds that we've got, we pay on to the loan and that any extra money over and above their minimum repayment is able to be redrawn from the loan. It's a harder process though because you've got to then put in a form, a redraw form to the bank and then they've got to transfer that money into your bank and it takes time.
Exactly right.
Right? Whereas an offset account is a separate account that is linked to your home loan. So any money that is sitting in there offsets the amount of interest that you pay. Now with a redraw, any extra money you've got sitting on the loan, you're still only paying the interest based around whatever the balance of the loan is on a daily basis and charged monthly. Same with an offset account, it's basically just the whatever money you've got in there offsets the interest and therefore you're paying lower interest. The main difference really is with redraw, any money you're sitting on the loan lowers that loan amount and sometimes can lower the repayments. To make the best benefit of having a redraw facility is continue to make the repayments as if you didn't have that extra money in there and you'll win. Whereas with an offset, same deal, you're still paying the same repayments. It's just the percentage of interest that you're paying on that loan changes.
Exactly. And I think a lot of people get the two mixed up because they're very similar in ways, but they're also very different in ways too.
So let me ask you, Rolly, in what circumstance, and sorry to turn the tables on that, okay. But in what circumstance would you use a redraw facility over an offset?
I've seen people more of a self-control thing is what I've probably seen it the most is obviously it's a lot harder to get the money out of a redraw than it is in an offset account being just an account that's sitting there.
You hear me going, yeah.
You're taking my job. But yeah, that's pretty much the main reason we see
Absolutely.
that it's a self-control thing. If you trust yourself, go for the opposite. But sometimes
absolutely, it comes back to their individual customer and their circumstances.
Yep.
And if they're the sort of customer that has a lot of money sitting in savings in various different accounts,
Yep.
then an offset account is going to work really well for them, because then that money that's sitting in those accounts is going to be able to offset their loan and work harder than being sitting in just a normal account. Whereas if someone is living, month to month, week to week,
Yep.
they've got a few consumer debts and they're not great at saving,
Yep.
then a redraw facility is probably better for them, because then they're not prone to actually spending that money.
Exactly.
It's
Out of sight, out of mind.
Yeah, and it's harder to get at, so they're
Yep.
not likely to. They're not impulsive,
Yeah.
But it is absolutely about the type of customer. Yeah.
Exactly right. What do you think the biggest emotional mistake is that first home buyers are making at the moment? Obviously, being uneducated, not going to mortgage brokers, things like that. What are you seeing the most common thing for first home buyers making that emotional mistake?
I think the emotional mistake they make is understanding the amount of money that they can borrow. Mm-hmm. And I think one of the biggest problems that we have today is supply and demand. There's an undersupply of properties out
Certainly,
there.
yep.
So the property prices are quite high, and a lot of first home buyers are going in there thinking, well, they can go and buy $1 million property or,
Yep.
1.5 million, but their incomes aren't going to support that.
Exactly.
Without speaking to someone, understanding how much they can actually borrow before they go and shop. And, a lot of them, they'll think, oh, well, why can't we go and borrow, buy this,
Absolutely, yeah.
the house that we want and we touched on this last podcast about buying in areas that they are emotionally attached to,
Yep.
which is usually where we grew up and where we,
That is out of reach.
If you grew up in the eastern suburbs of Sydney, you may not necessarily be able to afford to buy in the
exactly.
eastern
Can't even afford a car park over there because they're going for ridiculous money. I made a video about this the other day too. People come to me and go, oh, I want to buy a $1.3 million home for my first home. And you sort of got to go, okay, well, let's unpack that. Obviously, you got to have the deposit,
Yep.
the serviceability, and where are you trying to buy? Because obviously that's a pretty hefty first purchase. So let's unpack why that's your first.
And I guess it comes back to, do they understand how much the repayments will be? And when you break it down into, okay, well, you want to buy this $1 million property, so your repayment per month is going to be, $5,500 per month. You earn $6,500 per month. So that means that you're going to be left with $200 a week.
Yeah.
To live off for the
Good luck.
That's going to cover all of your utilities,
Yep.
your internet, your mobile phone, food.
Yep.
You can't eat.
No,
you can't afford to eat
No.
because you've got a mortgage, right?
You're dumpster diving.
So and I guess that tends to be a bit more of a generational thing as well.
Definitely.
I know that when I was out of school and my first home, we weren't looking at houses as such. We were looking more at, well, let's get into a unit, let's which we can afford.
Yep.
We create enough equity within that,
and use it as a stepping stone. So many people try to, I call them dreamers, because they just want to get the absolute best they can get.
They want to buy the castle.
Just right now, like everybody I know and everybody has stepped their way up from a $500,000 property to a 600, 700, 800,
Correct.
900, over $1 million. They didn't start at $1 million and just magically be able to afford that. You've got to use.
You can't necessarily get your forever home as your first home.
Yeah.
Why not live further out in a property? There are strategies that if you speak to your mortgage broker, if you've got a really good mortgage broker, like I know I've got a lot of good mortgage brokers, including Riley, where we teach them strategies on about home ownership, and anyone can give you a loan, right?
Yep.
And we can get you a cheap rate and all the rest of that. That's all great. But ultimately, once you've got that loan, what do you want to do with it? You want to pay it off.
Pay it off
right?
as fast as possible. Yeah.
As fast as possible. So what strategy is that mortgage broker going to teach you to help you pay that off as quickly as possible?
Exactly. And that's by using the different facilities.
And this is where it comes back to there not being the cheapest rate isn't necessarily the best rate.
Exactly.
It's all about, well, what products are available for the strategy that we have that's going to help you save, hundreds of thousands of dollars off your mortgage and cut down. Like, we can give you a strategy for most people where they can pay off their loan within 12 to 15 years, as opposed to 30 years, and save them hundreds of thousands of dollars.
Literally, right? Hundreds of thousands.
And it's not a difficult thing.
No.
It's just a matter of employing a strategy. And in today's market.
And sticking to it. A lot of people, they might have a amazing red hot plan right now, but 2 years later they're maybe tight for cash. They want to go on that holiday and they stop doing those things, and they wonder why their loan term's still at 20 plus years.
And with the right strategy and keeping in contact with your broker and working with them, you can have pauses.
Yeah, exactly.
Right? And that's why I say typically you can get a house paid off in 12 years with discipline. Right? But again, life happens. You start off as, you might be a couple with no kids and great careers, right? And all of a sudden, after 3 years, 6 years down the track, you might go, what, we're ready for kids. So then one partner is going to not work for a period of time.
And a lot more spending,
And a lot more spending, because you're going to have another mouth to feed, clothing, shoes, schooling, all that sort of stuff. So then the strategy gets reduced down a little bit. It doesn't mean you can't then, but by that stage, you've already created a crap load of equity, which you can then decide, okay, well, at this point in time, do we stay in this house, keep this as an owner-occupied, or do we rent that property out and use the equity that we've got there to buy our next home, which is bigger and going to accommodate for our growing family?
And using it as a stepping stone, not once
then
again.
Then we look at a different strategy.
Exactly,
again, right? So that's the thing, is we shouldn't be looking at home lending as rate focused, because rates don't mean anything.
No.
We got to think about our home purchase as, well, who's the broker that's going to give me a strategy to pay off this loan?
Exactly. And look, so many people go wrong by trying to do it all themselves as well. Like, that's why there's so many different professionals in our industry. You've got, accountants, financial planners, buyers agents, mortgage brokers. They're all to make that process so much easier. And trying to do it all yourself, yes, might be a great idea in theory, but a lot of the time, all these people do it every single day. They are masters in their craft, and that's where, if you can implement them where they need to be, you can have a way better experience and make a lot more money in the long run.
I mean, I guess for me, saying people want to do it all on their own, how do they, unless they're experts in finance, how do they know the right questions to ask?
Exactly.
How do they know, what's available to them? It's not the sort of thing you can look up on the internet and find out, oh, well, this is the perfect loan for me. If that was the case, we'd be going to banks and we'd be going and asking them for the bank, for the loan. Fact of the matter is, a mortgage broker has access. How many lenders do you have access to?
63 across the board,
I think we've got 84 now.
Oh, there you go. Even better. I'll change my bio.
But that's it. Like, if a customer's got the time to actually do it on their own, in other words, go and research, a dozen or so lenders and know exactly what they're looking for. They're not going to. We're experts in the industry. We know the questions to ask to find the best product and solution for every individual circumstances. And that's why, when we talk to a customer, we never talk about rate. We talk about, well, what are your financial goals? Because that's going to help you find the right lender and the right product for not just this purchase, but into the future. Because we don't care about just this one purchase. No. It's not a wham bam thank you, man. It's
the rest of your life.
That life journey with you. We're there to help you through that, create those opportunities and set you, help you with not just your owner occupied properties, but also your wealth creation.
Exactly.
And we've got strategies involved in helping you to achieve investment properties, whether that be leveraging equity to borrow shares or whatever that might be.
Yeah. And touching back on that again, that your mortgage broker will genuinely be with you for your lifetime of all of your wealth creation and that sort of stuff. So maybe if you want to go and investigate yourself and have a look at the banks, the big fours you got in your local area, they might offer good deals, but you're missing out on 84 other options. So it's
again, when was the last time the bank actually called you up and offered you a cheaper product?
Yeah, absolutely never.
They never do that, right?
Exactly.
So although banks always offer this and offer that, your mortgage broker is there acting in your best interest. And in my time, you talk about there for the lifetime. I've done loans for parents, and then as their kids have grown up and become of age, I've done their loans.
Yeah, which is crazy. Yeah,
and yeah, I've done multiple loans through for mum and dad, and then all of a sudden we're doing their kids' loans as well.
Exactly right. Yeah,
and that's the journey we build those relationships, and they are for life.
Exactly, yeah. And that is exactly why the market share is what it is. You know what I mean? I think it's 77% we're talking about.
You know why we do it for life? It's because, we care about.
Exactly, yeah.
The outcome. We care about, it's not about what we get out of it. It's all about, what they get out of it, because the rest of it will take care of itself.
Yep.
Whereas the banks are only after what's in it for them.
Exactly.
And that's why they'll never call you and say, hey, we've got a cheaper rate, would you like it?
Yep.
Whereas, we do a review. Typically you're not going to do one every year, but every 2 years we're going to be sitting down with you and going, okay, where are we at?
Yeah.
What's our goals? Because don't forget, when we sit down with you initially and work out what your financial goals are, goals change over time. As we just explained with, might come time to those goals might include kids, might include, buying vehicles, and might include going overseas on trips. Goals change. So we're here to help you, through those changes and work out what's the best strategy for you moving forward.
Exactly right. And, definitely an important thing there to remember is that, your mortgage broker will be with you for life. They'll constantly try to, find you the best product, best deal forever, not like the banks where they'll just set and forget, and all they care about is their profit. And, that's why we're here with so many different lender options, so that we can constantly stay on, in front of the 8 ball and not, leave unnecessary money on the table. Definitely.
So if you need a good broker, go and see Riley. He'll look after you. He's got all the strategies. You'll learn them all from me.
Exactly. All right, that was awesome. So thanks very much, Paul. We'll do this again soon. I think we'll have to name the actual podcast. We haven't actually done that yet. So let us know in the comments.
101.
Finance 101. Let us know in the comments what you think the best name for the podcast will be. Maybe we'll leave it up for the comments. All right, I appreciate it.
Thank you.
Thanks very much.
Thank you.